And so a little bit of about our program today, Transformation Thursdays, is an offering that we're able to provide holistic, culturally relevant virtual programming focused on various business topics for entrepreneurs at all business levels. So we can continue to meet you all where you're at in your business journey. Since 2020, all of our virtual events have been complimentary offerings to increase access and to continue to build community with you all. And with that, I'm bringing us to today's presentation. I am so honored and excited to introduce Chantay Moore. Chantay is a certified financial educator and licensed financial professional with 20 years of financial industry experience. Her mission is to help Native American families and business owners reach their financial goals by becoming financially savvy, economically empowered. As the founder and CEO of Native American Financial Literacy Services, Chantay is a nationally recognized tribal consultant specializing in offering expert financial literacy programming, having taught over 300 financial education workshops to date. Chantay Moore has proudly taught financial literacy workshops for many tribal organizations, including the Native Learning Center, Native American Chamber of Commerce of Illinois, OWISTA, American Indian College Fund, to name a few. Chantay earned her bachelor's degree in accounting from Roosevelt University in Chicago, Illinois, and earned her master's of business administration from Grand Canyon University. Chantay also volunteers her time by currently serving on 2 nonprofit boards in Chicago and enjoys traveling across the country with her 3 kiddos. And with that, I'm going to go ahead and stop sharing and turn it over to you, Chantay. Welcome and thank you.
Thank you so much, Jen. I appreciate the introduction and hello to everyone out there. To Native Women Lead for inviting me to be on this webinar and recognizing my expertise and amplifying my business. I love Native Women Lead. I was telling Shadeen, like, I remember when the organization first started, and so this many years later, being brought back as a presenter, it's truly a full circle moment. But thank you for that wonderful introduction, Jennifer. I am going to do my best, everyone, to make taxes sound exciting. Okay. I wanted, it's often not a fun topic to talk about. Sometimes it's easy just to not think about these things. Or you're like, you know what? Sometimes too, we feel a way about dealing with our government and the IRS and the Internal Revenue Service. So I want to acknowledge that as well. But my goal is that you walk away learning something new. I hope you walk away learning something that you might have never thought before, and just knowing that when it comes to money, what I've learned in being in the financial services industry for 20 years is that you just have to learn the rules of the game and play the game. And that's what I'm going to teach you is some of the rules of the game. So quick disclaimer before I get into anything. I have like 45 minutes to talk about this robust topic. So I designed it strictly for educational purposes. I'm not here to give anyone advice. I'm not here to tell you what to do with your money or your business. I'm just going to educate you on some strategies that's available. If I share any examples, they're just that, they're examples for hypothetical purposes. And one thing when it comes to the IRS in particular, the Internal Revenue Service, is they change rules, they change laws all the time. And so even especially if you're watching the recording, some things that I'm talking about or I mentioned today, it could have changed. They can change. So I just want to, make sure everyone is aware of that as well. And you won't learn everything on this webinar. These topics that I'm talking about, I'm really highlighting them. I'm not going deep into these strategies. So if it's something you're interested in, at the end of the webinar, I will share my contact information so folks can connect with me, a special offer that I'm making, and, take notes. I'm also going to be sharing these slides as well. And I do want to apologize in advance because I tried to put pictures on, but again, we're talking about taxes. We're talking about the Internal Revenue Service. So it's a very text heavy presentation. So that's why I want to make sure that I share the slides with you, so you're not just trying to write everything down. Feel free to take screenshots. It's totally up to you all. Oh, last thing. I definitely want to engage with folks in the chat. I'll try to address any questions that are general. What I find is sometimes when we're talking about money, people just start sharing all their business. Look, don't put all your business out there, okay? If it's a general question, I'll definitely address it. Okay, let me move on and kind of get us grounded. Benjamin Franklin had made this quote, in this world, nothing can be said to be certain except death and taxes. Um, it's true. We know that these two things are inevitable. They will happen. We got to learn how to deal with it. And I'm talking about taxes. We have to learn how to understand taxes. And so my goal today is I'm going to be teaching you about 7 tax strategies that I feel as an entrepreneur, if you take advantage of these and if it makes sense, that you should start saving money on your taxes. At least 10,000 up to $90,000, if you start implementing these strategies. I'm not here to make a guarantee. I don't know you. I don't know anything about your business or your tax situation, but I do know that these strategies help save you money. Another thing, I'm not here to replace your CPA or your bookkeeper or your tax person. That's not my job. I'm not here to diss them. But what I found as I became a tax strategist is that a lot of those folks, their business is to prepare the past. They're going through your numbers from the year prior. As a tax strategist, I look forward. I look at like, what can we do now so that we can change the numbers moving forward. But I'm not here to say that they're not doing their job. I'm just here to give you different options that you could probably go back and share with them. And some of these strategies you could start implementing right away. So I hope that you're encouraged to say, you know what, that makes sense for me. I would definitely, love to maybe see if that makes sense and go to your professional team to help you with these things. So the 7 strategies that we're going to talk about today, and mind you, there's as a business owner, as an entrepreneur, no matter what level you're at, I recognize some people are just getting started. Maybe you haven't even started your business yet. Some people could probably be well into their business, very mature in their business, years doing well. These strategies, it depends on your scenario. There's almost 40 tax strategies that entrepreneurs can implement. I'm only highlighting 7 of them today. So I just want you to understand, like, that's how significant the IRS, when you hear about tax loopholes, again, we're just going to learn the rules of the game to play it. I'm just going to teach you about 7 strategies, but there's so many more. So this is not the end all be all. I just wanted to think about, like, for the amount of time that I have, what can I really share with folks that could make probably the biggest impact right now. So we're going to talk about an S Corp election, an accountable plan, cost segregation, the Augusta rule, hiring your kids. I love talking about that one. The Section 179 deductions, and then leveraging retirement accounts. Another um, one of my favorite, I would say, facets to talk about when it comes to taxes. All right, so let's go and start talking about the S Corp election because this one kind of is the basis for a lot of other strategies. And again, I'm not here to give advice. Let's just talk about what's available to us. Because when it comes to an S corp election, let's just take a step back. When a lot of us are starting our business, right? You could be, making jewelry at home and taking Venmo payments. You could, eventually you could be at the flea market selling things there. You could have a digital business. Typically, when we first start our business and we're getting started and we're receiving income, we're initially filing our business income and expenses with our personal returns on our tax return, the 1040. And the form that we use, the schedule that we use is called a Schedule C. So your tax preparer will say, okay, well, what was your income? What was your expenses? How much did you spend on gas and things of that nature? That's how we generally start out interacting with the IRS when it comes to our business. Now, what an S Corp is, it's a pass-through entity for tax purposes. And that pass-through entity, what it means is that the business itself does not pay federal income taxes. Instead, the profits and losses of your business are passed on to shareholders. And then as a shareholder, you would report those losses, those profits, whatever it is, on your own individual tax returns. So think of, I'm just going to use basic examples. Like think of you being a one woman show. You're the only person who is in your business. You run it, you do everything. So if you were to elect as an S corp for your business, you would be the only shareholder, which means all the profits and losses would pass on to you individually, and you would report that on your tax return. And how we do that is through a Schedule K-1. So hopefully you have some tax professional who will help you prepare the Schedule K-1, and you use that to file your share of the business's income deductions and credits. So that's the basic idea of the S corp. It's just an election of, you're basically like, let's say you have an LLC. You can go to the IRS and say, I want to elect to be an S corp, and there's a form to do that, which I'll mention in a little bit. And why is this beneficial? One of the first primary reasons why this is beneficial is because we can really start what we call income shifting, where we are allocating profits through the business to you as a shareholder, which then minimizes taxes. And again, I'm gonna do my best to make this engaging, okay? But let's take a step back to think about, how do we normally report our income? If you're a Schedule C filer, um and you're reporting your income, once you say, well, I've made $10,000 for my business after all my expenses, you then have to pay self-employment taxes, and the self-employment tax rate is at 15.3%. Now that's broken down for Social Security, that's broken down for Medicare. If you make over 200,000, you pay an additional tax for Medicare. So if you're not an S corp, if you're a sole proprietor, if you have an LLC, you're going to report your business on the Schedule C and pay self-employment taxes. And for anyone, if you have a business, if you're earning $400 or more in that type of income, you're going to be subject to self-employment tax at that 15.3% rate. And again, this rate could change, but this is what it is for right now. So and that can be expensive. If you're making significant income on your business, paying 15.3% of that for self-employment taxes can be very expensive. And this is the scenario where you could be overpaying in taxes. So with the S corp, you'll say, you know what, I don't want my LLC to just be a regular LLC. I want it to be an S corporation. Now, what we're doing is we're going to shift our income. We're going to pay ourselves a reasonable salary. So instead of just having, the money coming to me directly into my business checking account, I'm actually going to engage a payroll company, and I'm going to become an employee of the business, meaning I'm going to pay myself a salary so that I can have a W-2 issued to me at the end of the year. And what that means is that I now have to pay payroll taxes to for Social Security and Medicare versus self-employment taxes. And in addition to paying yourself a reasonable salary, and I'm not here to tell you what's reasonable, you can determine that with your tax person. You can also take the rest of the money as an owner's distribution, which means that you're not subject to payroll taxes on the rest of the money that you take out. Now, let me show you guys an example of this, because it makes sense when you actually apply some numbers to this. So let's just do an example of a business. Let's say you make $100,000 in your business in net income, and net means after expenses, everything comes out. If you maintain yourself as a Schedule C filer, as a regular sole proprietor LLC, you have to pay all $100,000 of that as self-employment income, which means that you would owe over $15,000 in self-employment tax. Now, on the contrary, if you were to elect as an S corp, pay yourself a reasonable salary through a payroll company. Let's say you said, I'm going to pay myself $50,000 through payroll, and the other $50,000 I'm going to take as an owner's distribution, meaning you could just pull the money out from your bank account into owner's distribution. In that instance, you only pay payroll taxes on the $50,000 salary. That's it. The other $50,000 you don't pay payroll taxes on. And immediately, just by implementing this strategy, you've saved yourself over $7,600 in taxes. Now, that's initially, we're looking for tax savings, right? Why would I pay over $15,000 when I could just pay $7,600? Now, some other benefits to this. And again, if I'm going through this fast, apologize. I got 7 strategies to get through, but I want to just get through them in time. As an employer, yes, you're going to work with the payroll company, but guess what? The business actually deducts the employer portion of those payroll taxes as a business expense. So you pay less in taxes, for Social Security and Medicare, but you also get to deduct those that you get to deduct those taxes as a business expense. With self-employment tax, you only get to deduct half of that 15.3% on your personal return. So there's a difference. You're saving money. And then another benefit of actually running yourself, creating a payroll for yourself for your business is it just opens up other doors for you. So one, you're running payroll. Just imagine you're creating benefits for yourself. Now you can introduce retirement plans to the queue, to your situation, which I'll talk about. You can also introduce health insurance, even if it's just for you. You can introduce health insurance that you can have for yourself as a business owner. That's a tax deduction. And the payroll company handles all your federal and state taxes automatically. So you don't have to, like some business owners I work with, they tell me, like, Shante, I'm saving up money because I know I'm going to owe the IRS at the end of the year. When you're running payroll, you actually don't have to do that, because the payroll company will make those payments for you to the IRS directly. So there's actually some huge benefits that you can, it really just opens up just some doors to you by electing to have an S corp for your business. Now, does this make sense for everyone? No, it really doesn't. As a general rule of thumb, like when does it make sense? Well, I just got started with my business. Should I elect to be an S corp? No, not necessarily. As a general rule of thumb, when you start having a net profit, meaning net profit after expenses of $40,000 or more, this is when you should start considering electing your business to become an S corp. Now, if you are making $75,000 or more in net profit, you definitely will almost always benefit by switching to an S corp. Like you're definitely losing out. You're going to be paying way more money on self-employment taxes than actually incorporating the S corp and taking advantage of all those benefits. One thing I will say is that some states do actually have tax implications where they want you to make $100,000 or more. I don't have a list of all those states, but just keep that in mind. When we're looking at what makes sense for my business, it depends on where you live. It depends on how much your income is. We gotta address those situations first. Now, a couple other key elements for the S corp. And again, I'm spending more time on the S corp because it just leads to other tax opportunities for you, is that when you have this type of structure of a business, it also reduces audit risk. Because as a Schedule C filer, I mean, have you heard of business owners who's like, I just write off everything. I write off all my meals, my gas, all their personal expenses somehow become a business expense, and they just add it as an expense on their Schedule C. Sometimes that could put you in a position where not necessarily that you'll get audited, but if you were to be audited, you're going to have to prove those expenses. So you don't want to just be saying, oh, yeah, I traveled and I spent $8,000. If the IRS comes back and audit you, you want to be able to show you actually had $8,000 in business travel expenses. And so with the S Corp, you really do, because of the structure and the inherent nature of, your business, how you're managing your expenses, you're not really going to have too many audits. And if you do get audited, you should be very well suited to prove, those expenses were legit. The S Corp, to be honest, it does give your business more credibility with the IRS and even with some lenders. Now, the one thing to make this successful is you have to establish reasonable compensation and you have to do it with a payroll company. It's not enough to just say, oh, well, let me write a check to myself for $50,000 and that's considered my income. No, you actually need to engage a payroll company to manage that payroll for you. And then again, any extra money out the business, it's no longer considered income, it's considered an owner's distribution. So that's a key element for you. And so to elect as an S corp, you'll file this form. It's called a 2553 with the IRS. You typically will file this by March 15th. So if you're thinking of this it's the deadline is already passed. It's passed a week or two ago, but you are actually able to file a late election, and then you can do your tax return as an S corp and send it in. So again, whoever's helping you with your taxes already, they should be able to help you with that. Or again, I mean, I'll offer myself as a resource toward the end. But if in 2024, if you made, $40,000 or more, you definitely probably want to consider doing a late election for this, right now for this tax season, if you haven't done your taxes yet. And then the last key element, then I'll take the question that came in the chat, is once the S corp, actually two things. For the S corp, you're limited to no more than 100 shareholders, which that's typically not an issue because it's normally you yourself and maybe your partner or kids who are working with your business who could be a shareholder if you want them to participate in those, profits and losses. And typically, you also are advised you don't want to hold real estate in the S corp. And I mention this because some people are real estate investors and they use LLCs to buy real estate property. If you have an S corp, you don't want to use that for holding. Generally, you don't want to use that for holding real estate. And then once the S corp is elected, you're no longer filing a Schedule C on your personal tax return. Your business will be filing a separate tax return. It's called an 1120S. And that's for your business. Your tax person will know exactly what to do because that's where we're reporting all the payroll taxes, all the expenses. It's a totally separate tax return for the business. You're no longer needing a Schedule C. So question that came in to see was, to show proof in Schedule C, are receipts and bank statements enough? Yeah, actually, that is. Like for me, and the second part of that question is, should we invest in a program like QuickBooks? It really depends. I find, like for me, my business, I actually don't have a lot of transactions. I mean, I buy supplies. My business is mostly virtual, so I don't necessarily have a lot of transactions. I don't find that QuickBooks is absolutely necessary. It helps with creating financial statements and documents that lenders might look for. But I got audited one time on my Schedule C. It was actually by my state recently. It was done by my state tax return. They were like, "Well, we see that you filed this business. We need you to prove your top three business expenses." And I was like, "All right, I'll prove it." And I printed out literally hundreds of my credit card, and this was my business credit cards, my business bank statements, and then I was able to show them like, yeah, these are legitimate expenses. So you don't necessarily need QuickBooks. I think if you're a transaction heavy business, like a restaurant, or you deal with a lot of different like arts and jewelry, and you really want to record those different transactions, the QuickBooks might actually be better for you. Let me just check these questions. Okay. I'm gonna try to answer some questions because I don't want to get too lost in answering a bunch of them. So question was, when can you pull owner distributions? At any time, when the money's there, you can send it to you, to your bank account. No, the owner distributions, they're not taxed at all. So it's just like you actually pull in legitimate money from the business. And then if you add health insurance, is that tax deductible for the company? Yes, it is. That's a business expense. Okay, good. Yes. And thank you, Jennifer, for keeping track of the questions. I'm glad you guys are following. Thank you so much. That makes me feel so good because taxes, again, they're not fun to talk about, but I want to make sure that we try to address as many questions. All right, let's talk about the second strategy, the accountable plan. The accountable plan is actually unique. I like this one too. It's a little strange, but it's different. So this is where an accountable plan, I'm just going to read it here. It's a reimbursement arrangement where the employer can pay back funds to an employee for business related expenses that they pay for with their own money. So for S Corp owners, remember, if you now elected to be an S Corp, you are both the employer and the employee. So think of it as you're the employee who's using your money for business expenses and the business is reimbursing you. So this is an actual written document. A professional will help you draft up an accountable plan, and they have very specific rules in this plan. You want to identify very specific rules on how to get reimbursed, and you want to make sure you follow it consistently, not just for yourself as an employee, but if you also have other employees that you may be reimbursing. So this is for S corp, especially an accountable plan is really nice for S corp and C corp owners. I'm not talking today about C corp because it's another level of a business entity. But when you're for S corp as an S corp owner, you can't do like your normal home office deduction. Like most people, when you're a Schedule C filer, your tax person will say, "Yeah, if you own your home, we can write off some square footage as part of your home office." With an S corp, you can't do that, but you can be reimbursed for using your home and a portion of the bill, utilities, insurance, all that under the accountable plan. So it's just reimbursed differently versus S corp. You just take the home office deduction. So why would someone do this? When you have an accountable plan, those payments that you're paying yourself from your S corp business, now the income that you receive back on your W-2 is not considered your income. So and the reimbursements that the business makes back to you are also tax deductible as a business expense. So it's two parts to that. You pay for your own business expenses as an employee, and you submit receipts to your business. Your business reimburses you that money that you get reimbursed. It's not included in your income as it on your W-2, and the business gets to write off those business expenses. So when we think about a plan and determining like what can I write off or what's considered an expense, your plan will determine that. You do want to have legitimate expenses that are actually business expenses that you incur while performing your job duties. So think of it, I don't know, let's say for example, I'm trying to think. Let's say for example, you own a food delivery catering service, right? As the employee of your business, you pay for like gas for the car, maybe you pay for supplies to deliver the food. You actually want to have real business expenses that are associated to the business to get reimbursed on. You also want to make sure you have your receipts. So this isn't just saying, "Oh yeah, I spent $250, reimburse me." No, you actually need receipts to document it. And your plan should indicate a time limit of how long you need to, submit your expense receipts to be reimbursed. It's normally 30 to 60 days, but you generally don't want to come back 6 months later and say, "Oh yeah, here's some business expenses I forgot to reimburse." Again, we're going to treat our business like a real business, like a real job. There should be a reimbursement schedule. Also, it should identify what's not reimbursable. So personal expenses like going to the club and, playing pickleball, those are not business expenses, honey. Those are personal expenses. And again, you must have a business purpose identified for that accountable plan. So this is separate. It allows you to still get those write-offs and deductions that you typically would do on a Schedule C. But now we have to we have a hardcore plan to justify those reimbursements. And again, that money that you get reimbursed, it's not taxable income to you, and it's a business expense. So it has a twofold purpose. Any questions about an accountable plan? Is this making sense, guys? Can you just give me a thumbs up or a yes in the chat? Just give me a thumbs up or a yes. I'd appreciate that. I want to move on to the third strategy. Okay. Thank you. Thank you all for that. All right, let's talk about cost segregation. This was a little boring, to be honest. I only have one slide on it, but I had to talk about it because it does help folks significantly with taxes. This is for those of you who have a business where you actually might own property, like maybe a commercial property, or let's say you operate your business out of a home. And what cost segregation does is it helps you lower your taxes through identifying assets in that property to depreciate. When we're depreciating, we're basically writing off the costs of that asset right away. And you basically get your tax savings sooner. So let's dive a little bit deeper into this. Thank you for the feedback. I appreciate that, you guys. So first of all, someone is going to come in and do a cost segregation study. The person is going to come into your place of business and they're going to look around. They're going to be like, okay, what assets does this person have within that building, within the property that we can isolate from like the structure itself because your structure is an asset as well, right? If you own the building, that's an asset. But what in that building or around it can we isolate as a separate asset to depreciate right away, so that we can write the cost of that asset off right away? So it could be stuff like carpeting, light fixtures, kitchen appliances, landscaping, driveways, sidewalks. These things that are attached to the property, we can actually separate them as a separate asset, consider them a personal property, and we can take larger deductions up front on those particular assets. So I just tell folks when it comes to cost segregation, thinking of it this way, your loan, because we're depreciating those costs, we're reducing, so when we're talking about depreciation, we are writing off the cost of that asset, which lowers your income, which then lowers your tax liability that you owe back, which means you have more money left to reinvest. That's all cost segregation does. Okay, that's all it does. um, and so to implement this, you have to get an engineering analysis. Again, like an engineer will come to your place and they'll do this cost segregation study. They'll put together cost allocation analysis, and then they'll help you determine, what can you depreciate on your personal tax return. A question came in one time or annually. That's a good question. I don't know. I don't know that offhand. Um, I would say probably like in the beginning of your business as you get started, or when you first buy that property. And think of it this way too. Like you don't necessarily have to use depreciation right away. If you have an idea of like, man, I might be owing some money to the IRS this year, you might then want to see if using this strategy would make sense. So it's not necessarily I would say typically though in the beginning when you're buying that asset, because that's when it has the most value. Think of a car when you buy it, when you buy a brand new car, what do people say? You drive it off the lot, it depreciates in value right away. So same thing with like a building. Well, I would say real estate though, they actually increase in value. So kind of think of it that way. Let's say you bought a brand new, like you own a restaurant and you have a brand new kitchen range, stove range that you bought while it's brand new. That's when it has the biggest value. As you use it over time, the value of it typically lowers. So that's when you kind of want to determine like when do I need that depreciation or what assets would give me like the biggest bang for right now. All right, let's move on. That's my one slide on cost segregation. And I only spend so much time because it doesn't apply to everyone, but I want to touch on it because some people, you might have a restaurant and it might make sense for you to do this. All right, let's talk about the fourth strategy, which is the Augusta rule. This one is actually unique. I didn't know about this until I was actually learning about some more strategies. It's also called the Master's Rule. You guys might see that. Oh, let me answer this because this is true. Ashley put in depreciation would be used over a certain amount of time. Bonus depreciation would be extra claimed in the first year. Yes, that's true. Typically when we're depreciating assets, it could be like 20, it's like 20 something to 30 years, 20 to 29 years, or we could do it right away. So that's why we just determine, does it make sense? All right. So let's talk about the Augusta rule. So there is a section in the IRS code referred to as the Augusta rule where you can use your personal use related to the personal use of your property. Like let's say, for example, you own a home. You actually do have to own property for this one. You can use your home for business purposes. And this specifically deals with the deduction of expenses for using of a home as a business space. So this isn't just like having a home office that you use for your business throughout the entire year. This is actually where you take some time to rent your home to your business. You can actually rent your home to your business for no more than 14 days a year, and that income that you make from renting it to your business is not taxable. Renting your home to your business allows you to claim a deduction at the business level because it's a rental expense to the business, and the income that you personally receive as a homeowner is non-taxable to you. So this one I really like. It's pretty cool. So when would you rent your home to yourself for, 14 days? First of all, it has to be a business purpose. This could be using your house for like team meetings, hosting client events, having board meetings at your home. Like you can get creative. I mean, we do events all the time, right? As Native people. So pick an event, rent your home out for it. for no more than 14 days, and you will qualify for this. You definitely want to have documentation. You want to show that this meeting, whatever, it actually happened. You want to have minutes, an agenda. Who are the attendees? Who actually came? And again, the properties that you use, they have to be your primary residence. It could be your secondary residence. It could be a vacation home. If you rent to someone else, you can't use this. You have to own the property. Um, and no double dipping. So if you use the accountable plan, because remember the accountable plan is you're writing off, portions of your home and utilities for, expenses that you're getting reimbursed. You can't double dip on the same area. So let's say you use your kitchen or as a home office. You can't use your kitchen as part of the I'm sorry, as part of the Augusta rule. You got to use like your backyard and your deck or something like that. And to use this Augusta rule, you have to be an S corp, a C corp, or a partnership. So you can't do this if you're just an LLC or a sole proprietor. Kiana. All right, Kiana girl said, if we're the only board member, does that meeting count with ourselves? I'm gonna let you figure that out. I don't think so. I don't know. I mean, maybe you could say no, I don't look, I don't want you to come up with no story to the IRS. I'm not gonna do that. But have say you're like interviewing board members. I don't know. All right, so let's talk about how to implement this. So the main thing is to actually conduct market research. You have to actually determine what's a fair rental value in your area. You can't say, "Oh yeah, I'm just going to rent my house for $10,000." If you don't live in an area where rent goes for $10,000, like it has to be pretty reasonable. Schedule the meeting, have your agenda, have a rental agreement with yourself. So you're going to have a rental agreement between you as a property owner and the business. And you're going to submit an invoice to your business to say, hey, you rent it from me. Here's my invoice. Your business pays you for that rental income, and the business will issue you and your social security number a 1099 miscellaneous form. That's what you're going to use to report on your personal tax return that you receive this rental income from the business. But here's the thing. The way that your income, the money that you get from your business is tax free is because although you have to report it on your 1040, you actually offset it as an other deduction. There's the IRS tax, section code here is listed, and this is where the IRS, you're basically telling the IRS this is not supposed to be reported though because it's a non-taxable income under this section, which is the Augusta rule. So boom. I mean, I really like this one. I have one of my tax partners in Dallas. He said that he advises his clients to rent out their home when like the Dallas Cowboys are having like like when Super Bowl was there, like when there's a big major event in the area, because then they can charge more. The value of renting properties or Airbnbs actually goes up during those times. So, make it work for you. Make it work for you however we need to see fit. All right, guys, let me hurry up and get through these things. Like the time is just like it's coming down on me. All right, let's talk about hiring your kids. I'm a mother of three. Any other mothers out there? Just put your hand up, chat. I love our kids. Let's take advantage of these little babies. And I'm not talking about using their social security numbers on credit cards. No, 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 no. I am talking about you can legit, thank you to all the moms raising their hands up there. You can actually hire your children to work in your business. And there's definitely some benefits that you and the children can have. Now, let's talk about this in a little bit more detail. So, first of all, the pay and the duties must be appropriate for their ages. I'll give some examples in a second on that. This is also a great way to involve your children in your business. Like, isn't that why we do what we do? Because we want to create a legacy. Like, we want to create something for our children that we didn't have. Like, I get chills thinking about this. I hope one of my children would love to take over my business. But anyway, this is a nice way to pay your kids for something that you might have paid somebody else to do, or you just would have used your precious time to do it. And according to the IRS and generally other like court cases, generally the youngest age is 7. That's typically acceptable. Now, I will tell you, another one of my tax partners, they were hiring their 3 and 4-year-old child. And again, As long as you could prove that your 3 or 4-year-old child could do that job, then there's no issue. So, like, an example could be like for me, being in the financial services industry, sometimes I deal with a lot of paperwork. I could make a job duty as to one of my kids just to, shred all the papers that I have to, I scan papers and I shred them. Their job could literally be just to shred my papers. That's something that a 3 or 4-year-old could do, right? They could put the paper in the scanner. I'm sorry, in the shredder. So I'm not telling you to determine what their job is. You think of that. But here's a couple things to keep in mind, when you're thinking about hiring your children. One, that those wages that you pay your children are deductible business expenses. So we get some tax savings from your business there. Also, we're taking that income that we probably would have paid ourselves or someone else out of our higher tax bracket to our children. They have a lower tax bracket. Don't ask me what the tax brackets are. It's probably like a 15-20% difference. But instead of paying, on our higher tax rate, we can pay income on our children's lower tax bracket. But here's the thing: if you pay your children below the standard deduction, which is $15,000 for 2025, your child shouldn't owe any taxes at all on a tax return. So that's a key thing. This answers a question that just came in the chat. If the business is a sole proprietor, LLC, or partnership, you can actually pay your children directly from the business. So you don't necessarily have to have them on payroll. You don't have to run them through payroll. If you have one of these entity structures, you could just send them money directly from your business bank account to whatever, account they have, or issue them a check in their name, to avoid Social Security. Now, if your business is an S corp, you actually will use another strategy that I'm not talking about today called a family management company. It's a whole nother strategy. I just didn't have the time to really dive into that. If you have an S corp, that's how you would pay the kids through that. And then this answers another question that came in the chat. To maximize this benefit, the children should be working in the business year round. So someone said, can I hire my 11-year-old to create a logo? I mean, technically you can, but I would give them more of like a longer marketing, social media, something type of role. Like sometimes one person came to me and said, well, what if I hire my kids to be models for my business? Like I sell children's clothes or something like that. Can I, would that could I hire them for that? Technically, yes, but that's typically like a one-off type of thing. You want to find something that your children that could be identified year round that they would be able to do. Let me see. Somebody said, can I show the last slide real quickly? Okay, there it is, real quickly. I gotta go back. I gotta keep going. A couple other things when it comes to the hiring your children to implement it. You want to have this really documented very well. Like have an actual job description. What are their duties? What is the agreed upon compensation? What are the terms of employment? So somebody said updating a website quarterly. Yes, I think that would make sense. That's kind of like a year-round role. Also document the hours and the tasks that they did. Pay them their money. Give your kids money. And then if you have your bookkeeper who's managing like QuickBooks for you, that pay, it wouldn't be considered like wages, it would be considered outside services. And then this is just on the tax prep side. Screenshot this because depending on how you file your taxes, it tells you what to file and what line item and how to mark it as an outside service or other deduction, other expense, all that other stuff. So it's really cool. I actually have not implemented this with my own children yet. I need to. But it's if you have the funds from a business to pay your children, then it's a nice thing to do. All right. Oh my God, guys, let me go through time up there. I want to rush. All right, section 179 deduction. This is another boring one, but it's pretty significant. This allows you to deduct the full purchase price of qualifying equipment. Remember how we were talking earlier about like depreciation? It allows you to deduct when you actually bought it and started using it versus waiting over years to depreciate that asset. So you get some immediate tax savings. You can write off the full cost in the year of purchase, and this will actually lower your taxable income significantly. So if you're like on Instagram or social media and somebody says, "Oh, I bought this brand new Porsche and it was a tax write-off," this is what they're doing. They're literally buying that car and writing off the entire cost of that car right away in that first year. This also encourages business investment because some people are scared, and not, I wouldn't say necessarily scared, it's a capital issue also, but you need to buy equipment and software and vehicles or whatever you need, but you're scared to. You're like, I don't have the money to, or, can I really afford this? This actually encourages business investment because you do get that write off right away, which reduces your tax liability. And it improves your cash flow because you don't have that big tax liability to pay, which means you have more money to reinvest in your business. So that's the extent of what I'm going to share on the 179. Again, I'm highlighting the like benefits, the highlights of these different strategies. Let's talk about the last strategy, then I'll wrap it up with my offer in the last 10 minutes that I have. Leveraging retirement accounts. This is my favorite part because this is what I deal with day to day as a financial advisor, is helping business owners save for their own retirement. Like I always tell folks we forget about ourselves sometimes, right? Like we're so like, I want to make money, I got to build my business. You need to retire someday too. You need to invest money. You need to set aside money to grow wealth. Like, isn't that the purpose again? Why have a business if you're not building wealth as well? And you don't have a company that you work for who can offer you a 401k. You have to create your own retirement accounts. And so a big missed opportunity is a lot of businesses just don't leverage retirement accounts. And so, again, let's start paying ourselves. You work hard, build wealth for yourself. We give so much to everybody else. What can you do for yourself? I want to highlight three specific retirement accounts that business owners can use. This isn't the end all be all, but these are kind of more simple, easy ones that you're able to establish. The SEP IRA, Simple IRA, and Solo 401k. All right, Melissa, she says her biggest interest. We need to get your retirement accounts established. All right, so the SEP IRA stands for Simplified Employee Pension Plans. This was what it is. It's an IRA. And mind you, all these rules that I'm about to go through are according to the IRS. These aren't Chantay's rules. These are the IRS rules. So when it comes to having a SEP IRA, this allows you to make high tax deductible contributions for the business and not pay payroll taxes on that money. If you have a SEP IRA, you as the employer, as the business, you're the only one who actually puts money into these retirement accounts. The employees cannot contribute. Only the employer will contribute to a SEP IRA. And how much can you put away? How much can we set aside so it's not included in payroll taxes? You can contribute up to the lesser of $70,000 or 25% of an employee's compensation in 2025. These limits, they go up almost every year with the IRS. So I just looked up what was the most recent limits for 2025. Employers, you can make flexible contributions. So, and this is really good for folks. Maybe you have like up and down income in your business. So again, you're not required like every pay period you have to make the contribution. You can make flexible contributions, which if if cash flow isn't like the same consistently, this is actually a good strategy for that, because you can make contributions whenever you want. You don't have to do it. You really don't have to do it at all. So as the owner, you can also have a SEP IRA for yourself and have the same tax advantages as the employees. So this is a tax deferred retirement account. It's intended to be until you reach age 59 and a half before you start pulling money out. That's how any IRA operates. And here's the thing though, if you do make contributions and you have more than one employee or an employees outside of yourself, whatever percentage you make has to be the same for all eligible employees. So for example, if you contribute 15% for yourself, you got to contribute 15% for everybody else. And that's the challenge where some people, like if you have like a question came in, hey Vanessa, I'm glad to see you on here, where if you have a lot of staff, she said, what if I have staff of 30 or more? this might not work for you because and you probably one of those staff people too, right? Like you don't want to, and not say you don't want to give people 15%, but that's a lot of money to set aside for everybody, right? This might make sense if it's just you, like a partner, like your family members, where you have no problem giving everyone that same contribution. So an alternative, and these plans all have their, pros and cons. So a different type of IRA we could establish is a simple IRA. This is called a savings incentive match plan for employees. This is designed for businesses with 100 or fewer employees. So Vanessa, this might make sense for you. Don't know. As an employee, your employees get to decide if they want to set aside some money for their own retirement account. There's catch up provisions if they're a little older. As the employee, you can also save money into your own simple IRA pre tax. This is all pre tax money, which is great. As the employer, though, you are required to contribute either a flat 2% for everybody, or you can offer a match up to 3% for what employees contribute. Whichever one you do, that's tax deductible and you don't pay payroll taxes. So that could be an option. It just depends on your business and your cash flow. Solo 401k. This is actually retirement plan. If you're literally a one woman show, one man show, this is really with high income, this would actually probably make better sense if it's you and just a spouse, no other employees. The business owner, you are the employee and the employer. You can make contributions in both capacities. This one allows you to actually set aside a lot of money. As an employee, you can contribute up to $23,500 or 100% of your income. As the employer, you can make another, in addition, you could also contribute a profit sharing contribution of up to 25% of your own compensation. So between the both of those contributions, whatever the employer puts in, that's an expense to the business and it's tax deductible. And then from both sides, between you as an employee and the employer, you can't put in no more than $70,000 in 2025. Okay, guys, let me wrap up here. Um, Solo 401ks, I work with a lot of truck drivers. This is a perfect plan for truck drivers because they have so much cash flow that solo 401ks actually work really, really well for them. So I wanted to actually include this snapshot because I only talked about 7 strategies. There's so many others, like these advanced tax strategies. We didn't even touch on these at all. But I wanted to kind of give you an idea of like income because you still also might be a W-2 income earner. You might be working part-time somewhere, full-time somewhere, and running your business. So it really just depends on your income, your cash flow, like what plan makes sense. For if you're mostly W-2, a lot of these strategies won't make sense. You really do have to be a business owner. So in this, you'll have a copy of the handouts. You guys could look into that. A couple final thoughts I just want to share. There are a lot of tax strategies. I hope I did a good job sharing just 7 of them. I want folks to though understand everybody's situation is different. Just because something works for them in their business does not mean it'll work for you. It depends on if you're married, a homeowner, do you have kids? How old are you? What's your business? It really, really does make a big, big difference on your individual situation. Even if you're a partner in a business and you make the same income, same expenses, you're still 2 different people. So you might have 2 different scenarios. My biggest feedback is just don't try and figure out all this stuff on your own. Work with professionals to help you. As a resource, I want to be available to folks. Part of my work is I do offer a tax assessment product. Where I can learn more about you, your business, your income, and then I'll be able to give you a quote to say, yeah, I can show you what strategies work, how much they'll save you, and then to see, it basically tells you what to do to implement these strategies. You can schedule that you can schedule free consultation. So I do offer a 30-minute consultation. You can schedule that using the QR code or the bit.ly link. If anyone comes to me through Native Women Lead and their awesome network, I'm actually offering a $500 discount to you all for that, so that you can get your tax assessment and you'll know exactly what strategies you can implement. Otherwise, feel free to connect with me. I'm a I hate to say guru or expert, but I know what I'm talking about, guys. Okay. I send out weekly email newsletters. You can connect with me on email or social media. Jen, I'm done. I made it in the time frame. I'll pass it back over to you. Thank you, everyone, again, so much for your feedback and the engagement.
Yes, I echo everybody's sentiments. This was such a beautiful workshop. Thank you so much, Chantay, for imparting all of your wisdom onto all of us. We're just so appreciative of this opportunity to continue to learn and grow with you. And thank you all for joining us today and for choosing to spend your time with us. It means so much. It means the world to us. And just would like to invite you all to share words of gratitude and appreciation to our wonderful speaker today, Ms. Chantay Moore, for again sharing all your wisdom and knowledge with us today. It was super helpful, and just appreciate the gift of your time, and wishing everybody a lovely rest of your week. Have a great day. Bye, everybody.